So, in this section, we will look at calculating the working capital requirements of this business. So, working capital is just a measure of financial efficiency of a company. Basically, it tells the treasurer how much of the company's cash is in the hands of external suppliers at any one given point in time. So, in order to run a business effectively, typically you would have to produce whatever goods you are selling. So, you'd buy your raw materials and then you would fabricate that or process it to arrive at a finished good available for sale. And then you'd sell that good to a customer. And then between the time that you provide the customer with that good or service, the customer would typically take some time to pay you the revenue that you are due after supplying that good or service. So during the time while you're waiting to receive the revenue from the client, you still have to continue paying your fixed and variable costs, so your salaries, your electricity, etc., etc. So the working capital is just the lifeblood of a business. It allows your business to continue operating while you are expecting payment from your external customers. So we're going to calculate how much cash this business needs to continue its ongoing operations whilst waiting for its customers to pay it the revenue that is due to it. So we will begin by analyzing our costs, our fixed and our variable costs, and then we'll also look at the income side, which is our revenue, and then we'll combine all of these factors to arrive at our working capital requirement. So looking at our fixed costs, we can just link this line again to the top and just drag that across. So these are just our fixed costs which are incurred throughout the life of this model. We can then split up these fixed costs. So let's assume that we had the granularity in the model and the information that we required in order to determine that of these fixed costs, 50% would be due to salaries and wages. Let's say maybe 20% would be electricity, and then the rest would just be 10% for mill consumables, storage costs, and other suppliers. So these are fixed costs, meaning that they are incurred whether or not the business is actually producing goods available for sale. They will be incurred regardless. So out of this $500 million, this is the proportion. So 50%, in other words, $250 million is salaries and wages, and the rest would just follow suit. So 20% would be electricity, etc., etc. So let's assume that you pay your workers at the end of every month. So on average, you pay them after 30 days. Let's assume also that you pay your electricity bill after 30 days. You pay at the end of the month as well. Let's assume that you have to buy your consumables for your mills, and you pay your suppliers every 2 weeks. So 14 business days or 14 calendar days. Let's just assume calendar days here. Let's assume that it's also 14 calendar days for the storage facilities that you're renting out. You pay every 2 weeks, and also all the other suppliers are also paid every 2 weeks. So looking at that, we can say that out of the total fixed costs in 1 year, which is $500 million, on average, the business is sitting on cash for 30 days before having to pay its employees. So we can calculate how much cash is in the business during any one given point of this year. So on average, this business would sit with 30 days worth of salary costs inside the business. So this is technically a good thing because the business does not have to pay those salaries out immediately. It can still use that money within the business for other purposes. So let's just calculate what that would work out to. So we have that 50%. I'm just going to lock the column. 50% of this fixed cost is salaries and wages, and I'm holding 30 days worth of that. So that's 30 days. It's just multiplied by 30 days over 365 calendar days. So on average, it's about $20.55 million that is sitting in this bank account at any one given point in the year. this money is due to my employees, but I don't have to pay them immediately. So I can apply this $20.55 million to do other things within the company while I wait until the end of the month. After the end of the month, then I'd have to pay my employees again. So that's just on average at any given one point in the year, I have 20.55 in my bank account that is due to my employees, but I don't have to pay them immediately. So that's just the interpretation of this number. So I'm just going to lock the row here, and I'm going to lock the column here so that I can just drag this formula across and down as well. So the same interpretation would apply for these numbers within the body of the table as well. So on average, let's just say storage costs, it's 10% of your fixed costs. So in other words, $50 million are incurred in storage costs every year, but you pay your suppliers at the end of 14 days. So on average, at any given one point in the year, you're holding 14 days worth of that expense in your bank accounts. You don't have to immediately take that money out of the company to pay these storage suppliers. So that works out to about $1.92 million that's sitting in your bank account at any given point in the year that is due to your external suppliers, but you don't have to pay them immediately. So we can repeat the same exercise for our variable costs. Let's just find that line and link it. And then similarly, let's just assume that processing costs are 50%, mining costs can be maybe 30%, and then shipping 10% and packaging 10%. And then let's just assume that processing costs 14 days, mining costs 14 days, shipping 14 days, and packaging as well 14 days. So applying the same formula for your processing costs, we know that 50%, just locking the column, 50% of the total variable costs are attributable to processing. And then I know that out of these costs, I would pay my suppliers only after 14 days. So I'm holding 14 days worth of this 50% of 600 million, so 300 million. I'm holding 14 days worth of that. So if 300 million is incurred throughout the entire year, 14 days of that is just 14 divided by 365. And that works out to about $11.51 million is sitting in my bank account at any one point in time during the year that is owed to my suppliers. But I can still use that cash. I've got 14 days to play around with. I can still use that cash to do whatever I want to within my business before I have to pay out my suppliers. So again, locking the relevant rows and columns, so I can just drag that formula across. The same would apply for mining costs, for shipping, and for packaging as well. So now I have my costs that are divided up into various subcomponents, and as well that are reflective of how many days I actually take to pay out that cash to my external suppliers. So the last thing that we'd have to look at is revenue. So let's assume that we have terms with our clients that they pay us at the end of the month. So we deliver at the beginning of the month and they pay us after 30 days. So our revenue line was just up there. And now we can calculate what the working capital requirements for this business are. So we can look at what our accounts payable would be. We can look at what our accounts receivable would be. And we can also look at what our inventory costs are. Okay, so our accounts payable is the money that is due to our external suppliers that is as yet unpaid. So that's money sitting in our bank accounts. So because it's money that's sitting in our bank accounts, I'm going to treat it as though it's a positive for working capital. In other words, it's money that is in our bank accounts, so it's a cash inflow, if you will. So that would just be accounts payable, would just be all the costs that are incurred to our suppliers, which includes our employees, electricity, all of these mill consumables, all the fixed and variable costs. So basically, that is all of these costs here. That is money that is due to external suppliers at any given one point during the year. And I'm just going to drag that across. For accounts receivable, this is money that is owed to us. So this is money that is sitting outside of our bank account. So it's sitting with our customers. So remember, I said that I'm just going to treat the receivables as an inflow because it's money that is sitting in our bank accounts that is due to other people. Now I'm going to treat accounts receivable as a negative because it's money that is sitting with our customers that is not in our bank accounts. So I'm going to say out of this $2.7 billion that is earned throughout the course of a year, 30 days worth of it is always sitting in the hands of our clients and not in our bank account. So that's a drain for us because this money is not sitting in our bank account. It's sitting with our clients. I'm just going to lock that column so I can drag that across. Okay, so I'll treat it as a negative. And now we'll look at the inventory. And inventory is just the value of goods that are sitting on our shelves. These are finished goods available for sale, but for some reason, it takes us a while to ship those goods to our end clients. So let's just assume that this shipping and packaging, before we can actually ship those goods to our end clients, they sit in our warehouses for 14 days. So we would then record the full value of these goods and services that are available for sale. And the value of those goods and services is just what we've spent to get them into a condition where they are available for sale. So to calculate the value of that inventory, it is just the sum of all these fixed costs and all the variable costs that have been incurred to bring them to the point where they are available for sale. But seeing as though we have not shipped them to our clients yet, we have not incurred the shipping and these packaging costs yet. So the value of the inventory is just all the fixed and variable costs that have been spent up to date. This is just the value of the inventory that sits on our shelves for 14 days. So we would then take that figure and we would just multiply it by 14 days out of the 365 days in the year. I'm just going to lock that cell as well. So on average, we have $2.03 million worth of inventory that is sitting on our shelves. I'll just drag that across. So now we can calculate our total working capital requirement in each year. And that would just be the sum total of all the amounts that are owed to us from our external clients, all the money that we are keeping that is owed to our external suppliers, and this drain of inventory that's just lying idle on our shelves. So we add all of that together, and it means that in this year, we need to raise $166 million in order to fund our day-to-day operations at any given point of the year. So companies would typically raise these facilities as overdraft facilities, or they could just make sure that they have enough cash on hand, 166 million of cash on hand, in order to keep on funding their operations while they are waiting for their customers to pay them. And as well, that's offset by the amount of money that's sitting in their bank accounts that is due to their external suppliers. So to optimize your working capital, what you'd need to do is you would need to maximize the amount of time that you take to pay your external vendors. In other words, you want that cash to be sitting in your bank for as long as possible. And you want to minimize the amount of time that your clients take to pay you back. So you want to minimize this 30 days here. You want your clients to pay you as soon as possible. And that would just reduce this value of working capital, along with you don't want goods to sit on your shelves for too long. So if you do a combination of those three things, then your working capital requirements will come down. And the next thing that you have to look at is the change in working capital from year to year. So let's just assume that this business started operating in 2000 year one. How you calculate the change in working capital is you just take the current year, what the working capital requirement in the current year was, and you subtract from that the working capital requirement from previous years. So in this first year, this business would have had to raise $166 million to fund itself on an ongoing basis while waiting for its clients to pay it back. And that's, of course, offset by the accounts payable, and it's increased further by the inventory. But what happens in the following year, if we've already raised that cash or we've already raised that working capital facility, seeing as though we assume that this business just remains flat, there's no change needed in the working capital from year one to year two. And that just continues. There's no change necessary. You've already raised the amount of money that you need for working capital requirements. Now, let's assume that this business would come to an end in year 10. Then in the following year or in the following few days thereafter, the money that was owed to you from your clients would flow into your bank account. But you'd also need to make some payments to your suppliers that you haven't paid yet. And you'd also need to reflect this opportunity cost of idle goods staying on your shelves for 14 days. But this would all just unwind very soon in the following year. So what you find is that your net change in working capital over the life of your business should always sum to zero.